Let's welcome on board Harsha Upadhyaya, the CIO Equity at Kotak AMC as well, to make sense of what's happening in the market. And Harsha, help us just decode that because if you look at the Q3 updates coming in, they're not as bad. Of course, the virus scare is, kind of overmade. That's what the experts are telling us. And globally as well, nothing has gone all right to that extent that we should have seen that kind of correction yesterday. What would you blame it on, and what about the way forward?
Good morning. Clearly, as we enter 2025, valuations remain quite elevated. And at the same time, we have seen clear evidence of economy slowing down a bit. And also, the corporate earnings trajectory has not been great for the last couple of quarters. And the prognosis for next couple of quarters is also nothing significantly different. So to that extent, I think we have to get used to more volatility than what we have seen probably for 4 years since the COVID pandemic hit us. It has been a one-way street, and there has been significantly higher level of returns as compared to long-term returns from equities for all these 4 years. But however, as we look at 2025, I think returns are going to be more moderate, and also probably you will see a bit of more volatility in the year.
Returns were moderate last year also. 8% for the Nifty is in line with fixed income markets. So when everyone says markets are stretched, returns have been great, don't expect returns, 8% for the year gone by was not like a fantastic year of return.
You're right, Nikunj, but at the same time, the broader end of the market did give much better returns than what Nifty gave. But this year, I think that could also be under some sort of pressure as we see it. Because if you look at second quarter results for mid and small caps, so most of the companies have actually degrown by about 15 to 20%. And the third quarter is also unlikely to be vastly different. So to that extent, I think the reason for higher returns that you saw at the broader end of the market for 4 years since the COVID pandemic was also because of entry-level valuations being better. And secondly, the positive differential that was there between the mid-cap and small-cap earnings vis-a-vis large-cap earnings. For example, the mid and small-cap earnings have grown at about a CAGR rate of about 30% plus for the 4 years between 2020 and 24. Whereas large-cap earnings were somewhere in the region of 17 to 18% CAGR. However, as we look at next few quarters, I think the positive differential is unlikely to remain as high as what it was definitely. It could even turn into a negative differential. I think that's where even the broader end of the market could see a lot more pressure than what we have seen in 2024.
Sure. Harsha, given that you believe in the financial services theme as well, just wanted to understand how to best benefit from this entire structural idea, if you will, and then so many of its offshoots available in the market to actually play with. Where is it that you see growth as well as valuation comfort too at the current juncture?
Sure. Within financials, I think the clear opportunity seems to be in capital market related intermediaries and businesses. However, the valuations have kind of moved up even in this space. If at all there is one space where valuations are a lot more conducive for investment, that would be only a large bank space. However, in the near term, there are going to be headwinds. We have already seen that credit growth has kind of been under pressure. The deposit growth has not been coming through as market anticipated or as what it used to be in the past. There are certain regulatory overhangs, etc. So to that extent, I think still, if you look at our portfolios, while we remain positive on financials, it's still an underweight when you look at the overall sectoral allocation. Within that, while we are comfortable on the valuations for large banks, both private sector as well as public sector banks, we do believe that in the near term, probably that outperformance could be missing. It has to be more patient investing if you are looking at large cap banks. However, if you are investing into capital market related intermediaries, probably the growth trajectory is quite strong. There could be more volatility as you go ahead, but the earnings delivery and the growth trajectory are going to be really, really strong in this segment.
But aren't these valuations stretched? I mean, 50 times, 60 times, these are businesses which are available at consumer P multiples now.
Definitely, that's where I said the long-term growth still is very, very high. The penetration levels are very low for most of these financial services. However, from a valuation perspective, just like most of the segments in the market, the capital market segment or the subsegment is also quite rich in valuations. So that needs to be considered if you're investing and looking for returns in the immediate term. That may or may not come through, or it could be more moderate than what we have seen in the past. However, if you are an investor who's looking for next 3-5 years, I think definitely this is one space where the growth at least is unlikely to disappoint.
You've been bullish on cement for a while. Nilesh, who represents Kotak AMC, has been bullish on rural consumption for a while. Now, these are two big contra trades because cement has not done well in last 3 years as a category and FMCG has not done well as a cluster. What makes you bullish on both these contra bets?
Consumption still continues to be a dark horse. I think we need to keep watching out for green shoots in these segments. There has been very, very patchy kind of a consumption trends, whether you look at urban or rural at this point of time. But the hope is now it has been 4 years since the COVID pandemic hit us. So to that extent, I think rural population may have come through from that distress. There have been a lot of state governments which are also providing support to rural population in one form or the other. We have also seen monsoon being very strong last year, and the reservoir levels have been good. The agricultural production last season was quite strong. In fact, that's the only segment within the economy which actually surprised positively. And going ahead as well, this crop season, we are likely to see a reasonably strong output. And if inflation moderates a bit, I think rural population can have more income in their hands. Although I would say that probably the consumption basket itself has changed. What used to be spent on some of those mass market consumption items is probably going a bit into content, telecom, and even electronics. Having said that, I think there is definitely a real chance of rural recovery improving over the next 2 to 3 quarters. I think as you see more evidence, one can start looking at increasing exposure in that segment. As far as cement is concerned, we've seen quite a bit of consolidation, and the expectation was that there would be some sort of pricing strength in the industry, but that has not happened in the initial few quarters. However, now with the government capex picking up, and also we have already seen a little bit of pricing strength coming into the sector. If that develops into a slightly longer term trend, definitely the valuations can support cement sector as well, in our opinion. So I would say these two segments, while immediately there may not be a great uptrend in terms of the growth or in terms of the margins, but I think one needs to watch out and see whether some of the hypothesis comes through, and in that case, one can really build more exposure.
Talking about rural consumption coming back, but Harsha, is this the time to perhaps switch out of those, luxury and upper end of the consumption sectors like, let's say, real estate and the others, and switch on to rural, or not yet?
I won't suggest a complete switch as long as numbers are coming through in some of these discretionary consumption categories. We should continue to hold on to them. However, if rural starts to participate, then maybe the consumption names could be of a larger exposure in the overall portfolio. That's how probably we would look at going ahead.
Harsha, how much of the slowdown is in the price? How much of the slowdown is not in the price? Ultimately comes down to that. I mean, okay, whatever may be the construct of the economy, it's about what is in the price, what is not in the price. What are markets prepared for?
I think markets are not expecting Q3 or Q4 to be really, really strong for rural focused entities. In fact, a couple of those companies have come and warned the investors mid-quarter, which has been one of the reasons why people have discounted really bad numbers, or nothing likely to significantly change for these companies in the next couple of quarters. And in case things do improve over the next few quarters, and also if next year's monsoon doesn't disappoint, then I think there is definitely money to be made in some of these rural-oriented names. because while they have always been expensive compared to the markets, and even today compared to the markets, probably they are expensive. But if you look at a 5-year history of valuations in the FMCG segment, the current valuations are not too different from average valuations of the sector. So to that extent, I would say there is an opportunity there. But however, immediately nothing may happen.
Appreciate your time and so glad you could join us. Best wishes for a great year ahead.
Thank you, Nitish. Thank you.
If you like this video, then like, share and subscribe to ET Now.